Hello and good morning. This is Val Lemoyne with the Real Estate Made Easy Group, powered by Keller Williams. Today, I am joined by my good friend Connor. Connor is a loan officer with Supreme Lending, one of the best loan officers out there. And so he is going to answer a few different questions about different loan types.
Thank you, Val, for having me. My name is Connor Wright. I do work at Supreme Lending Southeast. We are located in Alpharetta, Georgia, and our Southeast region services Georgia, Florida, North Carolina, and South Carolina. And I'm extremely excited to be here and talk a little bit about mortgages and give as much insight as I can today.
So let's start with FHA loans. Talk to us a little bit about that.
Absolutely. So FHA is a great program. It's a government program. So the minimum down payment on an FHA loan is 3.5%. And usually we find that an FHA loan is fantastic for first-time home buyers for the fact that they let you put down less upfront, and they also give you the ability to purchase at a lower credit score rating. So the minimum credit score for an FHA loan is 580, which is essentially as long as you have 580 over and you have a few other qualifications in that, you can usually purchase with a minimum of 3.5% down in that range as well.
Awesome.
Great program.
How do FHA loan interest rates compare to conventional loans, for example?
Great question. So usually FHA loans, the big difference on FHA versus a conventional loan is FHA is going to have a tiered program based on the credit score rating. So depending on your credit score, from 580 to 600, 600 to 620, 620 to 640, you actually bump into different credit score ratings where they'll give you better adjustments. So you can actually get pretty close to a conventional interest rate, if not a little bit better, depending on some situations.
Interesting. So you brought up conventional loans, so let's transition to that. Talk to us about conventional loans a little bit.
Yes, absolutely. So conventional is the most popular program you're most likely going to hear about. Conventional is a credit score rating usually that you can be safest to get in those between 680 and 700 plus. So that's going to be more than likely where you want to fit with those. They do offer a minimum down payment of 3% for first-time home buyers, and then the average down payment on those can be 5% for second-time purchases or up from there. So conventional still carries, the same qualifications usually as far as getting into that program. However, the only big difference is going to be that the credit score rating will be a little bit higher depending on what you're looking to do with it. So,
got it.
Still a great program as well, and a very popular one.
So, do you have to be a first-time home buyer to put 3% down on a conventional loan?
So you have to be a first-time home buyer, or you have to have not owned a home within the last 3 years. That actually gives you your first-time home buyer perk back. Okay. So if you've had a home in the past and you sold that home, you can actually still purchase with 3% down. However, there's another program that conventional offers called Conventional Home Ready or Home Possible, where even if you have owned a home in the last 3 years, if you make under a certain income limit, usually in Georgia it's around $65,000 or below, you can then put down 3% immediately after purchasing and selling your last home. So you technically don't have to wait that 3 years if you can meet that income qualification as well.
So what about, so you said you can put 5%, 10%, or 20%. What would be the advantages of putting a higher down payment?
That's a great question. So typically, the more down payment you put, of course, you're going to lower the principal, which is going to lower your monthly payment. But a lot of things, one thing that people don't think about a lot is you actually get more of a break on your mortgage insurance the more that you put down. So if you put down 5% versus 10% versus 15%, your mortgage insurance that you carry on your loan will get a little bit less expensive the more that you put in. And then all the way to 20% where you lose the mortgage insurance completely. And for those of you who don't know what mortgage insurance is, it's essentially a cost that the lender charges when you have less than 20% of equity in your home. There is an insurance that is required. It's called PMI, private mortgage insurance. And it's usually a cost that you pay monthly until you get to a certain level of equity where it falls off.
And how does that affect your interest rates?
So usually the more that you put down, the better interest rate you get as well. So that's a great point. So the more skin that you have in the game, so to speak, the more that the lender will give you more credits towards your interest rate to get better pricing on it. So as soon as you used to go from 3% to 5% or 5% to 10%, 10% to 15%, you get little small pricing adjustments along the way. They give you better interest, and then they also knock down your mortgage insurance. So you really do see cost being adjusted on both sides.
Awesome. Can you also talk to us about conforming and non-conforming loans?
Yes. So conforming versus non-conforming, what a conforming loan is any loan that fits within the certain parameters of the conventional territory. So conventional has their certain loan limits that they're willing to go up to in Georgia, 647, 200. So you can basically have a loan that goes all the way up into that amount. Anything over that, you're considered non-conforming at that point, and then you have to jump into different territories such as non-conforming, jumbo products, etc., that allow you to take out more of a loan than maybe you would have been that you could take out with conventional. So let's say, for example, you're purchasing a home that is $675,000. Well, you could still put down, basically, if you wanted, you could still pay down to the conventional limit, and you can still stay in a conventional loan. However, if you're purchasing a home that may be $850,000, eventually you're going to get to the point where you're going to have to get into the jumbo territory because your loan amount will be too large. So then you can get what's called a jumbo loan, which is a separate financing through private investors. So it does get a little bit more, tricky when it comes to the underwrite there, but usually it's still a pretty easy and clean loan for us to do. And it's a great product for those that are looking to purchase in that higher price range.
All right, let's transition to VA loans. What are VA loans?
So VA is a great product for all of our veterans. If you're a veteran watching, I appreciate your service, as does Val. So
Absolutely.
we offer VA loan for folks that are veterans, and usually that loan, most folks take advantage of it because it is 100% financing. So you can actually take up to whatever your purchase price is, you can finance 100% of that. You do not have to put a down payment. And also the closing costs and things get a little bit more favorable on a VA loan as well. So usually those are restricted to veterans or a veteran and can be on a loan with a spouse. It is not usable for children of veterans or parents or anything like that, where some programs may be. But a VA loan is still a great product for a current active veteran or active military service person or a veteran to take advantage of to purchase.
And I am MRP certified, which stands for Military Relocation Professional. So if any service folks out there have questions or need assistance, we would love to help. Great. What about USDA loans?
Absolutely. So USDA loans are going to be restricted to folks that live in what areas that are considered rural. So outside of the perimeter, more than likely in Georgia areas, maybe like Ellijay, Blue Ridge, Rome, Georgia. Those areas are going to be great for someone that's purchasing a USDA loan. So what USDA loan does do is similar to a VA loan. They do allow you to do 100% financing. So they allow someone that is purchasing in those areas to take advantage of less upfront cost of purchase. Now there are certain income restrictions depending on the area, and what is also important is USDA does limit the income not just of the person that is purchasing the home, but they limit the income of the entire household. So let's say you're a mom, you've got a husband and a few kids. Well, if any of those kids are in working age and they are also, producing income, and your husband's producing income, even if you're on the loan by yourself, we would still look at the income in the entire household to make sure that you still fit under those income limits of that specific area. But as long as you do, it is still a great product, and you can certainly take advantage of extremely low cost up front, which is usually helpful for folks when they're purchasing.
And so for the surrounding areas around Atlanta, what would you say is a approximate income threshold?
Yeah, so usually it's going to depend, like I said, on the area, but more than likely it's around usually about 100,000 for the household.
So they have to make less than 100,000.
Correct, exactly
Okay.
right. And each different area, each different county has its specific income threshold. So more than likely, if you have a specific question about your area, we're always happy to kind of peek in there and take a look at it for you, just to make sure that we have things as accurate as possible for you. But yes, usually, and that does take into account the entire household as well.
So if people are getting ready to buy a house, what should they be doing to set themselves up for success?
Great question. First thing you need to do is make sure that you're very aware of what your credit score is. The credit score is going to be the biggest determiner of anyone looking to purchase. The credit score is going to determine what your interest rate looks like, what program we can put you in. It's also going to determine what your mortgage insurance cost looks like in some cases. So it's a very important parameter. First thing I would do is make sure that you feel that you're in a healthy place with your credit. If you're not and you feel a little bit less confident and you want some help on that, please get in touch with a professional like myself, Val, or any other professional in the mortgage industry that would be happy to take a look at that for you and at least lead you in the right direction. Now, outside of that, the next thing you should be doing as well is staying as cash heavy as possible, so not making any last minute purchases, things like that might take a lot of your equity away or your liquidity. And then the third thing after that is making sure that you stay away from any new accounts. So the best thing to do is if you can avoid purchasing any cars, opening up any new credit cards, any new lines of credit, installment loans, usually you're going to put yourself in the best position to purchase at that point, because you're going to keep yourself as slim on your debt to income as possible, which is going to give us as the opportunity to give you as much buying power as you can possibly get.
How quickly can Supreme Lending close on a loan from the time we go under contract?
That's a great question. So we can close a loan in eight days or more.
8 days?
8 days. So the ability to close that quick is usually unheard of in our industry, but at Supreme, we want to provide a level of service to our clients and our realtor partners so that you can be as competitive as possible in this market. I mean, I'm sure if you're watching this, you've probably seen that our market right now is very competitive, and there's a lot of folks that are looking to purchase. And so if you're coming into the market and you're wanting to be as successful as possible, giving you those tools to be to close as quick as possible and help you compete with those cash deals is very important to us, and we hang our hat on it.
Yeah, absolutely. Especially if the sellers have already moved out, and they have a dozen offers. If you have one that can close in 8 days when all the other ones need to close in 30 days, that would bring a lot of non-monetary value to the sellers to make our offers stand out. That's awesome.
Absolutely.
Connor, how do people get in touch with you?
The best way to get in touch with me is anytime by my cell phone number, call or text message. My number is 678-510-8372. Or if you get connected with Val as well, he would be happy to chat with you, and he can connect us just the same way.
Connor, thanks so much for coming out today. Really appreciate it.
I appreciate you having me.
All right, let's start over.
Yeah.
So there are other types of financing called creative financing that I'd like to discuss with you guys. One of my favorite types is called seller financing, and there are actually 13 different ways to structure seller financing if you know how to. And that is the equivalent of the PhD of real estate. So the most common and basic one is when the seller owns the house outright and they basically become the bank, except there's no bank involved. So what that looks like is you negotiate how much of a down payment to put down, let's say 10% on a $300,000 house. So that would be $30,000 that the seller would get at closing. So that would leave a remainder balance of $270,000. And so you would negotiate with the seller what interest rate to charge on that $270,000. And usually that interest rate is a little bit higher than a bank interest rate. So because otherwise, you would use the bank. And this time you bypass the bank completely, which saves you a little bit of money at closing because there's no origination fees. And you don't have to go through an appraisal, you don't have to go through underwriting, you don't have to go through any of that. So seller financing loans can close in 72 hours, basically as soon as the title is clear, and then you can close on a seller finance deal. You can also use OPM, that's another creative type of financing. OPM stands for other people's money. And so those would be a private money loan. So again, you're bypassing the bank, so you're saving a little bit on the origination fees. Again, the interest rate is going to be a little bit higher, and you also have a lot more flexibility. You again don't need an appraisal, although some private money lenders will still require for you to get an appraisal, just to make sure that they're not over lending on the asset. So guys, this is all the different types of financing that are available to you out there. Thanks so much for watching. Don't forget to like and subscribe.